Fidelity Investments Director for Global Macro, Yuri and Timber, joins us now to talk about it. Yuri, good to see you. I know you've been doing plenty of work trying to break apart exactly what's going on in the bond market, what yields at these levels are telling us for perhaps how restrictive, the bond market is against the economy, what it's going to mean for risk assets as well.
Yeah, so good morning. At the October lows last year, the market started to sort of pivot from one narrative, which is, the Fed is raising the cost of capital. And when that happens, the present value of future cash flows goes down. So bond valuation math stops working. The equity valuation math stops working. So that was the story for 2022. And then late last year, the market got pretty oversold. And the stock market decided to move on to an earnings recovery narrative. And typically, in the first 2 to 3 quarters of a market cycle, you see that recovery play out with rising PE ratios, which is exactly what we've seen, right? Earnings are still actually declining, but they're starting to decline at a less bad pace. Not that it was bad to begin with, because earnings are only down about 3% year to date. But the market's moving on to that recovery narrative. And as typically happens, the first phase of that is all PE. And so the PE ratio, which was 15 in October, is 20 now. The market has kind of front run a lot of good things that are supposedly going to happen, but now they need to happen. And on the earnings front, I think that's generally playing out. But as you mentioned, on the interest rate front, the bond market is giving the Fed giving the market some indigestion here. And I think ultimately it comes down to this whole kind of esoteric concept called the term premium, and whether the term premium really deserves to be negative, because historically it tends to be positive. You think about a term premium is the compensation that investors want to get paid for owning long-term bonds. And that could be a credit premium for corporates. It could be an interest rate premium, an inflation premium. And typically the term premium is positive, but it has been negative, and it's still negative despite fiscal deficits, despite, foreign currency intervention in China. And so I think that's really what's driving yields higher here. And the market has kind of moved on. And I think this is a wake-up call that maybe it's moved on a little bit too much.
So what's gone on a little bit too much? The stock market had kind of gotten too far ahead of itself relative to the cost of capital, relative to where risk-free rates are. I guess the question is, we're in this zone right now of talking about these invisible kind of factors in the bond math, right? We have the neutral rate. You talk about the term premium. We're talking about potential growth levels in the economy. What does it mean, in your view, bottom line, for the stock market? Just as everybody got comfortable calling it a bull market and calling for a soft landing, we've had this gut check.
Yeah, and I think the bull market narrative still stands, but the market kind of rallied in a pretty symmetrical channel. It got to about a 20.5 PE. If you look at maybe a 50% retracement down to the 200-day moving average, that gets you an S&P of around 4,200, 4,150. That would be an 8-9% decline from the peak that we already saw, but certainly not the end of the world. But you raise a good point. R-star, inflation expectations through the TIPS market, these are all just assumptions, right? So when the Fed is at 5.5, and we assume that R-star is at 1.25, and you add inflation of 2.5%, which is the Fed's target for the CPI, you get to a sense of the Fed's pretty restrictive. But what if R-star is higher? What if the TIPS market is wrong? And this is what makes investing in real time so difficult, because you're always dealing with assumption. And on the valuation side, you have the same thing, right? It's like, what kind of earnings growth do you plug into a DCF model? What kind of risk-free rate? What kind of equity risk premium? And so, this is kind of the point. And it's one thing if we're sitting at the lows in October, where really nothing good has been priced in yet. But now we've had this 5 PE point rally, an almost 30% rally, based on the expectations that certain things are going to happen. And now they need to happen. And if they happen, but maybe later or not as much as the market thought, you get this indigestion. I think that's kind of what's happening here.
Yeah, we absolutely had kind of worn away whatever cushion we had there. You're in 4,200, a little below that, gets you toward the 200-day average too. So maybe it all comes together that way. Appreciate the time. I'll talk to you again soon, Urian. Thank you.